Okay, tonight we're going to look at Chapter 7 of your textbook, The Investment Decision. The material that's contained in that chapter involves what we accountants refer to as capital budgeting. Capital budgeting is the concept of making plans for the acquisition of assets and the expenditure of money and potentially the receipt of money in the long term. Not decisions that are easily reversed. They may involve things such as building facilities, acquiring equipment, and so forth. And therefore, it's very important. They're also usually very expensive. It's very important that managers make a good decision about acquiring these types of assets. As the second bullet point refers to decision making and control, this is a very important concept for managers. In my mind, it's the number one responsibility of a manager. When you're evaluated by your superior, one of the major things that I believe they're going to look at is, did you make good decisions? And this capital budgeting is a technique that can help to support decisions which may have more long-run benefit than short-run. This next slide talks about these 5 stages in capital budgeting, and these are also 5 stages in the decision-making process that a manager has to go through. First, identify the project. Which type of capital investment is necessary? There may be many alternatives for a particular project. You might need a piece of equipment to use in the lab, and there may be 5 vendors who manufacture and sell that equipment, and each piece of equipment has different features and different costs as well. So the first step is generally to determine which if it's an equipment purchase, which pieces of equipment are the ones that am I going to focus on? Which are the ones that I'm going to do analysis with? Once you've determined what the project is, obtaining the information allows you to determine what costs and potential inflows are going to occur in the future. In this sense, we typically refer to inflows, but that also can refer to savings that a capital budgeting project may involve. So for instance, if you're considering the purchase of a new piece of equipment, and if you do acquire that equipment, then the maintenance cost may be reduced. You may have a piece of equipment now that requires maintenance 4 times a year, and perhaps this new piece of equipment would only require maintenance 2 times a year. Well, the fact that you're not engaging, in effect, being charged for the maintenance personnel to do the maintenance is in effect a cost savings, which can be factored in through this analysis to help support the idea of acquiring this machine, which is, as I say, typically large sums of money can be involved. The third step, to forecast the potential cash flows. I can't emphasize how important this is. The crux of capital budgeting analysis is to understand what cash flows are associated with individual projects. And clearly, the hoped for outcome is that the project will support itself and in fact be cash flow positive, that it will create more cash inflow than the cash outlay that's given up for it. But the problem is, in effect, forecasting those cash flows, because we're talking about future. You buy a piece of equipment, you may expect to use it for, let's say, 5 years. Well, 4 years from now, what are the costs going to be associated with that piece of equipment compared to what they are today? And I don't mean in respect to time value, I just mean in respect to general inflation and other changes that may occur over time. So, but it's important to identify the cash flows. In for-profit businesses, where taxes are an issue, when they depreciate assets such as these, the annual depreciation reduces the amount of tax that they have to pay because it reduces their income. And as such, they end up saving tax money when they make these capital investments. And that savings that they have on an annual basis, as long as they're depreciating the asset, represents a pertinent cash flow in these types of situations. Nonprofit organizations who don't pay income taxes obviously don't have that particular incentive and issue when you're doing a capital budgeting analysis. After all the information is in and you've had an opportunity to project the cash flows, then you can make a decision. You're looking for, if, as I mentioned before, maybe you've got 5 pieces of equipment you're potentially looking at. Which one has the greatest benefit and or the least cost to the organization? So at that point, you make a decision. You decide, yes, this is the machine we're going to buy, and you recommend it, and it gets purchased. After it gets purchased, the 5th step, you clearly have to get it set up, get it calibrated, so that it can do the job that it's supposed to do. So careful implementation. And then once the piece of equipment is up and running, the next thing is to evaluate the performance. Because remember, the analysis that you did used projected cash flows. And as time goes by and you actually incur the cash flows, at that point you can determine after the fact whether or not the project has satisfied the requirements that you might have suggested it would satisfy when you did your capital budgeting analysis. So the evaluation of the performance after the asset has been acquired is a very important step as well. And I've got a couple other bullet points here talk somewhat about the same thing that I was talking about before. Obviously, you have to obtain the funding to buy the asset, and then you, as I say, you track the flows as they're realized, the actual cash flows that occur, comparing those to the projections that you had earlier, and then making revisions to your plans as needed. Okay, as the book discusses, there are essentially 3 capital budgeting methods that we're going to talk about in this course. And I'm talking about them in a slightly different order than the book presents them, in part because I deem the first one here, net present value, to be the most important, the most useful, and the most conceptually sound. Now, we will also discuss internal rate of return and the payback period as well. All right, net present value uses the concept of discounted cash flows. And the idea of discounted cash flows is based on time value of money. With discounted cash flows, what we do is we look at those future flows of money that occur in future periods, and then using an appropriate discount rate, we determine the present value of those individual cash flows. If you're looking at 2 different equipment purchases, and one has a lower cost but is expected to last for 3 years, and one has a higher cost because it is expected to last for 7 years, then clearly the 2 machines have cash flows with different timing. There's also the issue that at the end of 3 years, you would have to replace the machine that only has a 3-year life. Well, the idea of trying to equate the value, if you will, of those machines over time is what we accomplish with discounted cash flow with net present value techniques. We take the cash flows associated with the 3-year asset and we discount them back and determine a net present value for the current day. And then we do the same thing with the 7-year asset. Take those cash flows that are anticipated with that and bring it back to the current day. And then we can then compare both of those net figures to one another and determine which one has the greater benefit to the organization. This slide mentions the required rate of return. That's the discount rate that I referred to. It's the minimum acceptable annual rate of return on an investment. That means that if the organization has established that they will not invest in any project that does not have a 10% return, then that becomes the discount rate. You have to be able to generate that 10% return, or the organization may just not make the investment, even though you might feel that there are savings involved. It may not satisfy the investment criteria. The required rate of return is defined as what you could get if you had to make a similar investment of similar risk. So it tends to be determined by what the cost of money is to the organization. If they had to borrow money, what interest rate would they have to pay? Yeah, also called the discount rate. Okay, as I said, the net present value method calculates the expected monetary gain or loss, the net figure, by discounting all the expected future cash flows using the discount rate. And we can easily see that based on financial factors alone, whether a project is acceptable or not. It doesn't necessarily mean it's a good project just because the numbers are good. Here's a method for determining net present value. It starts by sketching out the relevant cash inflows and outflows, scheduling them, which happen at the end of year 1, the end of year 2, the end of year 3. We will essentially assume that those cash flows happen at the end of the year so as to make it easier to do the computations for the present values. To the extent that we might be talking about annuities, we're talking about ordinary annuities rather than annuity dues. All right, the second step is to convert the flows into present values using the techniques that we talked about in Chapter 6. There can be both inflows and outflows. Typically, there is a big initial outflow, and that's the payment for the piece of equipment that you have. That initial payment is presumed to happen at time 0, and then everything is discounted. The present value comes back to the time when that initial payment was made. So in effect, the present value factor for the initial outlay is 1. 1 times the outlay being the present value. Okay, so and then the final step is to sum each of the present values from each of the different time periods that are involved. They've all been discounted back to the same time point, and then sum the totals. If the net present value of the project is positive, that means that the discount rate that was used in the analysis, in the capital budgeting analysis, if the net present value is positive, it means that the actual return is in excess of the rate that was used in the problem. If the net present value is 0, then the discount rate equals the actual return that we would get from the asset. And if the net present value is negative, the implication is that the project is not generating the return that's required, that was used anyway in the capital budgeting analysis. Before I take you through an example, just a few slides to talk about what's important in the analysis and what numbers are necessary in order to do the analysis. The question boils down to these so-called relevant cash flows. And the only cash flows that are really relevant in the circumstances are those that differ in the future. Any cost inflows or outflows that are not changed as a result of this decision do not have to be considered. So for instance, if you're going to bring a new machine into a lab and you have personnel in the lab already that you're paying that can run the machine, then you don't have to hire anybody. You're not laying anybody off either, so the cost of that individual's wages and benefits are going to continue in the future. That's not something you need to even think about in terms of doing the discounted cash flow analysis. Yes, it is a cash flow that will happen in the future, but because it doesn't differ over time, it doesn't need to be considered. Categories of cash flows. First of all, the initial investment. You'll see that in a minute. Basically, that is the outlay for the equipment. In organizations that are for profit, this is an important distinction because the fact that they are entitled to depreciate the asset means that they have a cash flow outflow that happens at the beginning of the time frame, but then they also have cash flows that happen after then as relate to the savings, the tax savings of their depreciation. Again, that's not something you need to worry about here. We're going to keep it in the nonprofit realm, but understand that in the for-profit world, that is a very relevant issue that has to be dealt with. So anyway, the initial investment is certainly a cash flow outflow that you're going to have. The cash flow from operations. Now it says after tax, but you can consider that there is no tax. It's just the cash flow from operations. What happens? Am I able to do things? Am I able to sell more goods because I acquired this machine? Am I able to process things quicker and therefore have savings because of that? What's the inflows and outflows that are going to occur from operating this piece of equipment? And again, only those that differ in the future are necessary to be considered. And then finally, the cash flow from the disposal of the asset, which means, you know, if the machine still has some life left in it at the time when you dispose of it, you may find somebody willing to pay for it, and that becomes a cash inflow in the future that needs to be discounted back to time zero. The other item listed there is the recovery of working capital. We'll talk a little bit about that in a second. So the initial investment, obviously the purchase of the machine itself, as I mentioned earlier. The second item here, the initial working capital investment. Working capital, you'll recall, are current assets minus current liabilities. Easiest to think of this just in terms of the current assets. If you acquire a piece of machinery, it may cause a change in your average receivable balance in terms of who owes you money. It certainly may require that machine that you have to obtain some supplies that you have to keep on hand in order to service that machine. And the fact is that those supplies need to be purchased. They need to have cash that's used to purchase those supplies. So maybe you got to have $1,000 worth of supplies when the machine is delivered. And then you work down those supplies over time, but you end up replacing them also, so that you always maintain some inventory of supplies over that time period. Well, in doing that, you have locked up cash for a period of time, and therefore the initial investment computation includes that initial working capital investment that you might have. And the third category here, you might not think of this as an initial investment item, but if there is an existing machine that can be sold, then that becomes a cash inflow that again occurs at time zero, if you will. So that if the old machine had a salvage value of $1,000, that $1,000 would be treated as an inflow at the time that the outflow occurs for the purchase of the other machine, the new machine. All right, a couple of points here about cash flow from operations, because a lot of times these equipment decisions are done specifically so that they can impact the overall operations of the organization, obviously in a positive manner. So it's very important to measure carefully the expected inflows and outflows from the project. The first one here, the inflows from producing and selling additional goods and services. Production may be increased. Maybe new tests can be offered that can be sold more efficient. I can imagine there might be different tests that'll test for the same thing, and some are more expensive than others. Different types of equipment might produce different test selling prices. And as I mentioned, operating costs can be saved, which is akin to a cash inflow. We do exclude depreciation, of course, even though it is recorded as a reduction of the income. It is an expense. It appears on for-profit and not-for-profit books. The important thing is it is not a cash flow, and consequently, there is no discounting applied to the depreciation number. The second point is the item of depreciation for-profit organizations. This is referred to as the depreciation tax shield. If my tax rate is 25% and I have a $20,000 depreciation deduction, then I'm saving 25% of $20,000, $5,000 that I'm not having to pay in income taxes. And then finally, at the end of the project, you're done with the machine. It may have a disposal value, the same as the old machine did when this new machine was purchased. And then if working capital is freed up, if you no longer need that inventory of supplies, then it's appropriate to free up the working capital and dispose of the inventory and report that as a cash inflow. Okay, this is a very busy slide here, but bear with me. It details all the information that you need to know in order to do net present value. Looking up here at the top, we're talking about a net initial outlay of $379,100, a useful life of the project of 5 years, an annual cash inflow of $100,000, which would potentially mean that there are both inflows and outflows associated with this machine, but that they net to $100,000 and that amount is received at the end of year 1, 2, 3, 4, and 5. And we're given a required rate of return here of 8%. The first step is to sketch out the flows, and that is done right here. So we've got a timeline starting at time 0 and extending out 5 periods. In time 0, the initial payment is the $379,100. As I said, that present value factor is 1, so the present value of that flow is exactly the same. The outlay that happens at the end of year 1, the inflow at the end of year 1, and you'll notice the sign is different here because there's brackets and no brackets here. At the end of year 1, that $100,000 has a present value using an 8% discount rate of $92,600. And in year 2, with a discount rate of 0.857, it's $85,700, the present value of that inflow that happens 2 years out. So on for 3, 4, and 5, and then all of that discounted back. At this point, all the numbers here are additive because they're all in the same time period. They're all the present values. Another way to put this is it's not appropriate to look at what we have here, which is a $500,000 inflow and a $379,000 outflow, and just relate to the fact that, well, that's $120,900 of difference, and because it brought in more money than it cost, it's a useful project. That may or may not be the case. When we present value everything, we bring it back, we can sum them, net them, and that's what this is, the net present value. So if this machine is purchased, the net present value is $20,200. As I indicated before, what that means is that the actual rate of return on this project exceeds the 8% rate of return that was used. There is some rate that can be employed that will cause this net present value to be zero. We'll talk about that in a couple of minutes. So this part down here you can look at, it's just recognizing the fact that we have an annuity here, a constant stream occurring at fixed intervals, and consequently you could use the annuity tables to do the discounting. And of course, because the annuity tables are derived from the present value tables, they are the same solution, $20,200 as the net present value. Okay, the second method is the internal rate of return method. And the internal rate of return method puts things in terms of the rate that's employed in the present value analysis. The method involves determining when the net cash flows have zero present value. Not so much when. The question is what rate causes the net cash flows to have a zero present value. When you're using the internal rate of return method, then the decision rule is you will only accept a project if the rate of return equals or exceeds the required rate of return. And so we're doing the same thing here that we did with net present value, just with percentages instead of dollars. With net present value, we accepted the project if the net present value was zero or was greater than zero. Well, zero is when the internal rate of return equals the required rate of return. And if the internal rate of return exceeds the required rate of return, then that implies also that the net present value of the project is positive. So, the one thing that's a bit of a pain about the internal rate of return method is that without a computer program to do the arithmetic, and Excel will do this, but your calculator will do so only grudgingly, I think. The other approach is a trial and error approach. You basically keep plugging in different rates of return and keep refining that rate of return until you hit the point where the net present value comes out to be zero. So as it says down here within that second bullet, if you choose an interest rate to determine the internal rate of return and you do the calculations and the net present value of the cash flows is greater than zero, then that means that the actual rate of return is higher. So you bump up your estimate. And if the calculated net present value is less than zero, you go the other direction. As it says in point 3 here, you keep going until the net present value is zero. All right, here's essentially the same information we had in the previous example. Now talking about the internal rate of return. It's the same initial investment, same life, same cash inflow, but now the discount rate that's employed on this worksheet is 10%. The reason that it's 10% is that we know from the previous analysis that the net present value of the project was $20,200. That was the result when the net present value, when the interest rate was 8%. If the net present value is positive, then the interest rate has to be higher than 8%. And through whatever method, trial and error, it turns out that the internal rate of return for this project is exactly 10%. So what you see here are the same sketched cash flows, but now the discounting takes place at 10%. In the other case that I showed you, it was 8%. This is 10%. When we do the discounting now, the present value of the cash inflows sums to exactly the present value of the cash outflow, and consequently the net present value is zero. As long as that net present value is 0, then this is the rate of return, the internal rate of return in the project, 10%. Looking at the two methods, net present value and the internal rate of return method, you can read this slide. The bottom line is the net present value method is the preferred method. And the internal rate of return method is useful in circumstances where you want to compare different rates of return that a project might generate, and that can be important in a decision. But typically, you can answer all the questions in terms of net present value. Doesn't make any difference if the projects have different lives in terms of the length of time the benefit will be there. Net present value is the preferred method. Internal rate of return method also suffers from the fact that very infrequently would the future cash flows, the annuity that will create the return, end up being constant over time, which makes measuring the actual rate of return even more complicated than what was demonstrated when you do the trial and error method. It's the last method, the third method that's discussed in your textbook, is the payback method. And the payback method is considered the simplest capital budgeting technique. And because of that, it's easy to understand. In many cases, it's easy to calculate and it's easy to conceive of. So it is popular in that method, in that respect. Generally speaking, paybacks are useful where you have a lot of decisions you have to make, or not a lot of decisions, but you have one decision, you may have a lot of options. So there may be 30 different machines that you need to look at. And rather than doing a present value analysis on each and every one of them, one of the first things you might do is try to do a payback analysis on each of them and sort of screen them in that fashion before doing a more detailed present value analysis. I certainly would not make a decision to invest in an asset of significant dollar value on the basis of the payback method alone. The payback method in conjunction with net present value is just fine. The bottom bullet points there, the two weaknesses: doesn't recognize the time value of money, and it doesn't consider what happens after the payback occurs. So all it does is tell you how long will it take to recoup my investment without giving consideration to time value of money. It's calculated by taking the amount of the original investment in the asset and dividing by the increase in the annual future cash flows that occur. You know, how are we going to recover this investment? It's because we have net future cash flows that are positive. That's fine when the cash flows are uniform. The problem is they're not always uniform, and in those cases, what you have to do is sort of a frequency analysis, and you need to build up the cash inflows until it reaches the point where they equal the cash outflow that was made at the beginning of the time period. So if the original outlay was 10, and in the first year there was an outlay of 1, the second year an inflow of 1, and the second year there was an inflow of 2, the third year the inflow of 3, and the fourth year an inflow of 4, then the payback period would be 4 years, because in 4 years you would have recovered the 10, the 1 plus the 2 plus the 3 plus the 4. The other point there that it's making there, the fact is, well, what about the fifth year? Maybe in the fifth year it's bringing in 5, but I'm not even taking that into consideration when I look at the payback method alone. So it is a legitimate technique, but it's not a very highly regarded one. Okay, this concludes the discussion of Chapter 7. I wanted to point out one thing about the homework. In the syllabus, I indicated that in the assignment for next week, you should ignore income taxes. A couple of the problems give you a set of facts and then ask you to do the computations, assuming that it's a nonprofit entity and then assuming that it's a for-profit entity. I want you to only consider the circumstance where it's a nonprofit entity, and you could ignore the portion where it asks about taxable entities. At any rate, thank you very much. I look forward to talking to you again next week.